The long-term cycle analysis of the markets suggests that we are still in an uptrend. Indeed, when we last spoke to our next guest, he was saying that we are now entering the biggest period of wealth creation in human history. So what does the threat or possibility of a COVID-19 style pandemic do to long-term cyclical analysis? Akhil Patel is with us now. He's the founder of Ascendant Strategy, but is also working with a new group, Property Share Market Economics. Let's turn to him and find out just where we are with all this. When we spoke to you late last year, Akhil, you were then talking about this opportunity that's due to come in the market. You were looking possibly for a little bit of a pullback at that time, but you were confident within this long-term analysis that you put together that we've still got some of the best years to come in the trend. Just explain where we are with this in the context of COVID-19 or coronavirus and US elections and so forth.
Well, thank you for having me back, Jeremy. So my views about the long-term cycle have not changed one bit since last December. So where we are in the current cycle is that we are approaching the midpoint of the cycle, and historically at the midpoint economies have entered recessions, and that has often been the cause of a stock market panic or a couple of years down in the stock market. And I was certainly expecting something of that nature in 2020 and into 2021, and I still think that's the case. What then tends to happen is that central banks and governments start to ease monetary policy and start to stimulate the economy through additional fiscal measures, and that sets the scene for the second half of the cycle, which is typically the much more bullish half. And so I'm still of the view that from the Federal Reserve's response to coronavirus by kind of cutting rates by 50 basis points to a lot of announcements with respect to public spending, the Treasury, the 11th March budget looking to be one which really boosts spending in the UK, I think we are really very much replaying the same sort of rhythm that we've seen in previous cycles.
The Fed's lucky in as much as it's got a bit of fat to cut, hasn't it, in terms of its monetary policy, but European Central Bank certainly hasn't. The Bank of England's got the slimmest of margins it could use. This is the problem about this part of the cycle you're talking about, the way in which we're seeing stimulus. Yes, we've got these stimulus measures put in place. The IMF is another one, of course, we've seen. I know South Korea's put in a tranche of money. So that's all very well, but how does all this play out in the terms of where the market's going in terms of the support that it needs? My understanding from what you're saying is that the dip that possibly might come needs stimulus to get us out of that. Where is that stimulus going to come from if it's not from central banks?
Well, I think we've seen over the last few years that actually the monetary policy side of the story has kind of run its course in some ways because interest rates are at such low levels, and also there was somewhat of an overhang, particularly in Europe, with very high debt levels being paid back. I think the next part of the cycle, the story is very much going to be about public spending and infrastructure and measures to make economies more productive. And actually, typically in the second half of each cycle, it is that story. And in fact, we saw that very clearly in the UK. The mid-cycle, last cycle was in 2001, and Gordon Brown enacted a massive increase in public spending and infrastructure and other additional pay for workers after that, and really drove the cycle forward into 2007. And I suppose, just to go back to your point about the coronavirus, I mean, with bull markets being so extended, with possibly the economy getting to a point where it was starting to slow, I think I was always on the lookout for a trigger point. Did I think in January that coronavirus would be it? No, I didn't. And I think a lot of people, a lot of investors probably were not aware of the impact it might have. But I think what we've seen now is a bit of a market overreaction to the current state of the news. Of course, if it spreads even further, then we will see another secondary panic. But it's certainly consistent with market behaviour at this point in previous cycles.
Whilst you're doing a lot of this sort of work at Ascendant Strategy, as I said, you're also working with Property Share Market Economics.
That's right.
What are you doing there? Because I'm interested to find out how your strategy overlays into other areas.
So we're doing a number of things, but principally we're bringing together a team of experts on stock market and property cycles, and then using that data spanning several centuries to develop roadmaps for the stock market and commodity markets and the property market, to provide investors with some sort of credible analysis as to how things will play out over the next sort of year or 2 years going forward. Because as I said, and we do very much remain of the view that the 2020s will be a really spectacular year for decade for investors, and we want our investors to take advantage of that.
Yeah, I have spoken to you before in a prior interview earlier on last year about the property market. If you could just explain to us again how this fits in. Is it just basically following the same cycle, or is it in a different cycle within the main long-term 18-year cycle?
No, it is the same cycle. So the 18-year cycle is typically 14 years of expansion out of the lows of the previous crisis. After around 7 or 8 years, you get a mid-cycle correction or recession. I think we've kind of probably worked through most of that in the UK, in the sense that 2018 and 2019 were pretty slow years for the property market.
Slow, but not correctional.
Not correctional, but you typically don't get property prices coming down very far in the mid-cycle. But what you do tend to get is by this point in the cycle, wages are starting to expand, and so you might get a certain correction in terms of housing unaffordability or affordability. And so we've seen in the last year or two that house prices as a multiple of median earnings has sort of got slightly better. And so that, with continued availability of credit, interest rates being relatively low, that supports the affordability case for new housing. In addition to that, the government is ploughing in money into the economy, and certainly the current government is determined to address shortage of supply in the housing market, and that sets up the scene for the next half of the cycle. And we're seeing all of that play out at the moment, and we'll see that continue in the next couple of years.
Yeah, just out of interest, as a background to this, so what do you see happening with interest rates? Does that form part of your research and output? Because I'm interested to find out if we do have this expansion, we do have this stock market boost, we do have the biggest wealth creation in human history. Mm-hmm. Do interest rates move up at that point? Is that something where the banks will be able to re-establish themselves as a really meaningful operator with monetary policy?
This is a really interesting question, and of course every cycle there is maybe something slightly different which you have to sort of take into account. I think there's a couple of points I'd make about that. One is that interest rates are historically low, and I think we've got to a point now after almost a decade of very low interest rates that we have got used to such interest rates, and so it might not take much of a rise in interest rates to cause certain reverberations around financial markets.
Because of the debt, presumably.
Because of the debt and so on. But on the other hand, inflation is quite low and remains persistently low, and now that might be for a range of factors. It might be because of the debt issue that you mentioned, but actually technology and that sort of side of things is also a big factor. And so I think interest rates can remain within a relatively low historical range. But what you do get during the second half of the cycle, and particularly into the peak, is a period of rising interest rates. And eventually that gets too far, it squeezes things too much, and that indeed induces the peak and then the subsequent fall. And because you've had several years of expansion, you then get a much more significant recession when that starts to reverse. And it takes, because the banking system is by that point involved, it's lent profusely, shall we say, to the build out of economies and so on, that it takes several years for the problems within the banking system to be corrected. And the aftermath of the global financial crisis after 2008 was an example of that in the previous cycle. But if you go back to the early 90s, we had several years of issues in the banking sector then, and similarly in the late 70s. So this sort of is a story that happens pretty regularly.
Yeah. Okay, let's just bring it all together again and talk about the rest of 2020, and assuming we do get this correction that you are so waiting for in order to get that final boost. Let's assume that happens this year, because we don't know, of course. What then, how many years do we then bank on there being this increase in wealth creation?
Well, I think the recession, if it happens, and it doesn't always mean it's a technical recession, and the UK avoided a recession technically last time in 2001. But it's usually sort of 9 months to a year at the most, and the stock market sometimes has a very significant correction. Sometimes it goes sideways for a couple of years. It's sometimes a little hard to predict. I would say though that we've had a very strong bull market since 2009, and so it wouldn't surprise me if markets did at some point in the next year or so come down fairly significantly. And
what is significant in percentage terms?
I think the nature of the bull market was relatively grinding for most of its existence. So I would say maybe 20 to 30 or 40%. Last cycle, 2000 to 2002, US markets came down 50%. I'm not expecting something that significant because we had a very major bubble into the dot-com peak in late 99, early 2000. I don't think we've quite had that nature of the sort of speculation to drive a panic of that proportion.
And then thereafter, how long does it take to get to the peak?
Well, I've forecast the next peak to be 18 years off the previous one, so we're talking about 2025, 2026, and so we're looking at least 5 or 6 years of pretty strong economic growth, together with stock market growth, together with asset prices rising, and so on. And indeed, as the other part of that story, when the second half of the cycle is a commodities boom, and that's partly to do with the build-out of the global economy, but also to do with longer-term commodity cycles, which I also analyse.
Okay, interesting stuff. Akhil, thanks indeed for joining us. Akhil Patel is the founder of Ascendant Strategy, also working there with the new group, Property Share Market Economics.